Hello, you're watching Deal Flow, the CNBC Africa show that keeps you up to date on the latest M&A trends in South Africa and beyond. We bring you the insights and analysis. We talk to the rainmakers, the financiers and the advisors. I'm Erika van der Merwe. Thanks for joining us. Funding impact through so-called development equity slowly is gaining attention in emerging economies. Across sub-Saharan Africa, various funding organizations intent on social and economic transformation are putting capital to good use while still generating appealing returns. We find out more about that. Our deals of the week set the scene.
Europe's biggest tour operator, TUI Travel, and its majority owner, TUI AG, plan to merge in an all-share, nil-premium deal worth around $7.49 billion. This is to cut costs and create the world's largest leisure tourism group. Ascendis Health, the third largest pharmaceutical company on the Johannesburg Stock Exchange, announced that it has concluded a Black Economic Empowerment Agreement with the Mine Workers Investment Company. This deal will see MIC's ownership in Ascendis increase over a 3-year period. Alexander Forbes will return to the Johannesburg Bourse on July 24th. The provider of financial and risk services announced that a unit of Marsh & McLennan will become a strategic investor with 34% stake after the listing. Alexander Forbes was delisted from the JSE 7 years ago following a buyout on consortium led by Actis and Ethos Private Equity for 8.2 billion rand. Also, Steinhoff has reduced its 61.8% stake in CAP to 45% following a book build. The furniture manufacturer and retailer will seek a primary listing on the Frankfurt Stock Exchange in September.
Welcome back. Now, what happens when you combine a developmental mandate and transformational thinking with a sensible drive to generate returns for one's investors? Development equity slowly is becoming a recognized term for this particular approach. My guests are Anne Keppler. She's Vice President at DEG Equity Mezzanine, and Stuart Bradley, founding partner at Phatisa Fund Managers. Welcome, Anne and Stuart. Good to have you here.
Thanks, Erika.
So, Stuart, I don't think this term development equity is in general use yet, but I see it's in one of your media releases. If you can explain, so presumably it's not about, it's combining this idea of developmental funding with a profit motive.
Yeah, it is. I guess it's a phrase that we've tried to coin. I think everyone's fairly familiar globally with what private equity is all about. And really all we are is private equity, but trying to take it to a new level, trying to measure the impacts that we're achieving in those investments. And therefore attracting finance from the likes of DEG, development finance institutions, combining that with private capital, and therefore looking to make financial returns, but also make significant development returns as well and measure those.
Right. So, Anne, where, as Stuart said, where he's a fund manager taking institutional funds and deploying it to important assets, you then are the institutional investor. You are an example of a DFI, the German DFI. If you could just first explain that, and why this developmental mandate might be important to you.
Yeah, absolutely. DEG has been founded in 1962, so we have quite a couple of years track record in providing development funds to emerging economies globally. Development finance for us combines like the commercial and the developmental mandate. So our articles clearly state that we have been established to promote development. At the same time, we are not following a profit maximization approach, but we still want to be sustainable and want to create revenues and profit to support more projects. In 2013, we have been quite successful with deploying about 1.5 billion euros globally into projects and supporting 970,000 jobs across the globe to be secured or generated. So for us, development is linked closely to commercial success, sustainability of operations, but as well as improving living conditions, which are closely related to employment, job creation and job securement.
And what sort of returns, financial returns, would be acceptable to you in that scenario?
We are quite following the commercial aspect as well. So our transactions need to be profitable. We partner only with the private sector. And we are not creating development. We are shaping and supporting development, but the actual realization, as for Phatisa's case, remains with our partners. So we facilitate, but creating impact is in the end part of our responsibility of our private sector partners.
I mean, if I can add there perhaps, I mean, what we've noticed from raising money from the likes of DEG, the development finance institutions, Development equity impact investing is not about compromising the returns. So people are still looking for the same types of returns that they would in a commercial environment.
And we're talking double digit?
I would say, double digit, high teens is what people are looking at in dollars. But on top of that, people are looking at measuring other things out of those investments. So measuring job creation, taxes paid to governments, gender equality, corporate governance. In our case, we're measuring things like what we produce. So we've got two funds, a housing and a food fund. So our mission in life really is to feed and house Africa, as we put it. And already in our agri fund, we're producing 50,000 tons of product a year for Africa.
So, and clearly from your institute's responses, they're metrics, right? You really have to follow, probably on a quarterly basis, the extent to which you are having an impact.
We are basically measuring the outcome in our terminology, because impact is quite a relatively soft part. What we define, we provide input to the companies in the means of finance, and as a development finance institution, we are a bank and a PE house on the same terms. So we provide debt, which is clearly not as high yielding as our equity investments are, where our return expectations are similar. Our financial input creates an output at the company level, and that generates an outcome, which are jobs, government revenues, and electricity infrastructure supply. And those parts, the real impact, are the soft effects in the end for us, which improving the living conditions.
So, and from your perspective, as an institutional source of funding, how do you choose your partner? So the fund manager, where you would put your funding, and with that also, how do you choose the asset that makes sense with that? Because there are times where you invest directly, not just through a fund manager.
Good question. That's what I spend most hours of the day on, finding those partners and the right assets in this regard. The fund managers we team with, or even commercial banks we team up with on the lending side, are our kind of extended arm, reaching out to SMEs, to companies where we cannot be present all the time, because we are a global institution headquartered in Germany with 3 offices across the African continent. But we basically want partner who speak our language, who believe that profitable and commercially sustainable businesses generate an impact, and who are there over the long term and not for a short-term rationalization and profit maximizing approach.
So Stuart, you too have to choose the right partners. So you want funding from institutional investors, but it's not just accepting any funding. They have to share the same vision. And those funders themselves, amongst themselves, must be able to work together.
Yeah, absolutely. It is... there's a spectrum in terms of type of finance you can raise. And to be fair, in our agri fund, actually, we've got people from either end of the spectrum. So we've got some very soft money on the one end. The European Union came in with $15 million of grant funding into the fund. What we've managed to do with that is use that on the side of the fund. So where we're investing in businesses, we can use it to support outgrower schemes, some of our suppliers, and build businesses around us, providing input to our businesses. We've also got some softer government money that's come into the fund, which we've managed to use creatively to provide really some underwriting on the returns for our harder investors. So some of the banks, some of the family offices, fund of funds, more of the commercial money that's come in. So we've managed to blend those types of finance, channel it through the fund, ultimately to look for a financial return, but also to give people those impacts as well.
And for you, Stuart, the selection of the assets, so if I look at some of your portfolios, some of it would be something you typically find in a private equity portfolio. Others are more sort of deeper sort of impact developmental vision that you have for those assets and those countries, like Sierra Leone.
Correct. Yeah, when we look at investments, we don't detract from the financial returns, but what we tend to do very early on is we score an investment basically on its financial returns and also on its development impact returns as well. So we've got 2 models that we run, and we look at both. So we might therefore, like Sierra Leone is a good example. It's an investment that typical private equity wouldn't have done. This was a palm oil mill that was destroyed in the civil war in the 90s, the only mill in country. We saw an opportunity to rebuild that mill, to acquire fruit from 9,000 outgrowers who were around the mill, who were processing by hand before we got there. And produce a product then for sale into the local economy, so import substitution. It was quite racy. It's in a difficult market. Sierra Leone, it's on the Liberian border, in sort of blood diamond country. And not many private equity firms would have gone there. But it's really ticking the boxes in terms of delivering some of those impact measurements, as well as the financial returns ultimately out of the investment.
And if I were to ask you a philosophical question, Could there be criticisms, you being a German of a development finance institution, for instance, coming in perhaps and imposing developed world, first world norms onto the emerging world in terms of what you perceive to be developmental criteria that you need to support? Or do you work with local governments and establish what exactly is required?
We work with local partners, and certainly in this regard with the local environment and the local regulation on those parts. We are not norm shaping on a country level. We are really private sector focused, and we want to support the private economy in emerging economies. Certainly you can always criticize certain approaches, and you can criticize standards. On the other hand, applying certain things like the International Labour Organization's rules on employment, on how to treat your employees, generate long-term perspective. And that's always the broad playing field of talking about environmental and social standards. And from our perspective, they are a risk factor to operating a company if you don't do it properly. And we want to create a sustainable business in terms of commercial viability as well. And hence, we do feel that one should adhere to those standards, and they can actually add much more value than they add burden in the beginning.
And I think given, it's a global playground now, if you want to call it, I think we're trying to attract more and more international capital into Africa. So, I think we do need these standards to sort of uplift these businesses in terms of environmental, corporate, social, in terms of how we behave. If we're going to want to attract international capital to come into Africa, but also to partner on investments, strategic investors to come in into these investments that we're creating in Africa, I think we do have to raise our game if we're going to bring that capital in.
And especially on the agricultural side, if you want to export products into the European Union as well, you have to adhere to certain production standards to make the product compliant, and that generates a whole new area of potential revenues for the company. And hence we do see it as an opportunity and not always as a threat.
And presumably also we're in a world post-donor funding, post-aid funding. I think the evidence is that it hasn't worked, and presumably there is a strong drive and a push from the development finance community to do it in a more sustainable way, as you're saying, that it is profitable, that it has a broader sort of impact on the region.
Absolutely. I mean, if you look at one of our investors, actually, the Spanish government came into the fund. This is early stuff for Spain, actually, when they joined our fund. I think they're probably now, since then, they've done a few more funds. But this was quite pioneering for them. They didn't even have a DFI agency as such. So this was coming from the Ministry of Finance, and they made a significant commitment to the fund. But correct, I think a lot of governments out there have seen, and it's not to take away from aid, because I think aid is still important in the right areas, education, healthcare. I think it's still very important. But I think what a lot of people are seeing but it's also about building sustainable businesses so that, when some of that money has gone and doesn't come back into Africa, these businesses are still standing on their own 2 feet and growing and, creating prosperity.
Anne and Stuart, thanks very much. Good talking to you. And so that was our focus, looking at developmental equity and how such patient capital can be a force for good across emerging markets, including in Africa. That was Anne Keppler. She's Vice President at DEG Equity Mezzanine, as well as Stuart Bradley, founding partner at Phatisa Fund Managers. From me, Erika van der Merwe, it's goodbye.